A resilient, future-ready bank needs to be financially, operationally, and organizationally resilient. To be financially resilient, a bank should have adequate capital buffers and be ready to generate earnings even in times of severe macroeconomic shocks. It should also have adequate liquidity to meet its obligations in various situations. Therefore, financial resilience is closely linked to a bank's business model and strategy. The Reserve Bank has therefore started looking at the business models of banks more closely. Aspects or deficiencies in the business model itself can spark a crisis in due course. We have not only prescribed regulatory norms for capital adequacy and liquidity ratios, but even gone beyond to nudge the banks to build up capital buffers in good times and times of plenty. As you may recall, we did this during the COVID-19 pandemic times when there was plenty of liquidity in the system, when the interest rates were low, and when the full impact of the pandemic on the financial sector was still highly uncertain. Now, talking about the business model, I think the recent developments in United States in particular, there is again questions about whether the business model of individual banks that have faced challenges, that have faced difficulties, whether their business models were right. There are questions being asked all around, but I am not going into that. Because these business models sometimes can sort of create risks in certain parts of the balance sheet of a bank, which going forward can blow up into a bigger crisis.